Hey everyone, it's D here from Positive Equity Trades, and in this video I'll be showing you some stock market tips. Okay, so what I'm going to cover here is first, risk management. This is something that you have to go by if you want to be a successful trader. Risk management is everything. It doesn't matter how much money you have. If you don't know or don't understand risk management, then you're going to have a hard time trading. Also, be prepared to lose. You have to not be afraid to take a loss. And I'll be talking about this and showing you an example later on. Gap fills. Gap fills are something that my friends don't really know about in terms of trading. And hopefully I will show you in this video what I mean by that. Also, there is a golden rule. Okay, so the golden rule that I'm going to be talking about will help you become a successful day trader or swing trader if you do follow the rule. And also there's some other rules that you can set for yourself as well to make you an even better trader. So usually for rules, how these rules even come about is that if you're doing something and it's not working, then what you need to do is change it. If you don't change it, well, then you just go back to the way you used to trade. But a golden rule, usually for traders, is something that is going to be very beneficial for you later on. So I'm going to be talking about that as well. Also, be careful trading at these certain times. So in this video, I will be going over these tips for you, and hopefully at the end of this, well, you'll be just a little bit better than you were before. All right, so let's get started. To start this video off, what I have here on the left is Kodak, and what I have on the right is Atos. So these are perfect examples of what I want to be talking about to hopefully make you a better trader. Okay, so the first thing is risk management. And also ties into the golden rule. A lot of the rules are a 3-to-1 risk to reward. So pretty much you're willing to lose $100 to make $300. Anything less than that, it's not worth it. So as for risk management, I'll show you an example of what not proper risk management is, and also be prepared to lose. Okay, so as for be prepared to lose, every time you make a trade, you're going to be risking a certain amount, and you have to be willing to lose it. All right, so that being said, also gap fills. So first thing is I'm going to show you what a gap fill is first. Okay, so I know it's not in order, but I want to show you pretty much this is how you can play. So for example, you see this right here. Kodak went from around $6 all the way up to $9, back down here. And then would you buy here? No, because it has a chance to fill the gap. As you can see, should I buy here? No, you wouldn't. All right, just because it has a chance to go back down to $6. So then you wait, goes back down to $6. Okay, it goes a little bit below, but afterwards goes back up. Okay, I have no idea what happened, but then $6 all the way back up to 11, and then back down to 8, and then should I get in here? So it looks like this. Would I get in here? I would not get in here because, again, I mean, it happened before. It could happen again. And what happened? It actually happened again. So then, as you can see, it goes all the way back down here to fill the gap. So gaps usually look to fill. And then, look, it goes back up again. It was like, oh, it's so high. Would I get in here? Hell no. Just because what are you willing to risk? Okay. So the target, you could say it's 14. Are you willing to risk $2 gain per share? Or are you okay with a, like almost a $4 decrease in share? Okay, so risk to reward, you would not do that. Risk management, you would not even. Right? So then what happened? It just filled the gap again. So then you could buy in the gap, which is a lot better because your risk to reward. What's your target? If it's at 14 again, or you're willing to risk losing, risk losing profit all the way to $8 to 14. That's pretty good. Okay, so as you can see, around 14 is the target. So how you do that is this. You would want to wait for it to come back down, fill the gap, probably buy it around here. If it doesn't, maybe around here or something like that. Okay, say you took a risk and you bought it right here. All right, at 7, say you bought it at 8. Okay, just for easy math. All right, you bought it at 8. If it goes down to 7, you're out. But if the 8 goes up to 14, then you're also out. So you see how you risk losing $1 to gain a potential $5 increase. So that is proper risk management. You should really follow those rules for yourself. And if you just keep trying to trade and it's not working out, well, then something has to change. Probably set some new rules for yourself, and then that way you'll become a better trader. So that is the gap fill. Okay, another example of a gap fill would be like this. Atos. So it went from $1.50, closed at $1.40, and it dropped all the way down to 60 cents. This is crazy. All right, so what happened was I actually got in around $1. Okay, and I was looking for a gap fill up to $1.40. Okay, so usually if that's the target, if you have that certain target, chances are a lot of people also have the same target. For me, I ended up selling it at 135 just because, well, people like, if that's the target, chances are people are going to sell before then. So therefore, 135. So 135 is actually where I sold it. I actually sold it at the tip on that day. But what happened afterwards was it came back down and then just kept going. So it looked to fill the gap before doing anything else. So this is the gap right here. And it looks to fill. After filling, I'm fine with taking my profit. And oh, what do you know? I missed out on some gains, but who cares because I was practicing proper risk to reward. All right, so gap fill, I was playing the gap fill. This over here, you would get hurt if you don't look at the gaps. So as you can see, it goes up, down here, fill the gap, fill the gap, fill the gap again. Chances are I most likely will be looking to buy the stock on Monday just because, well, if it happens so many times, chances are it's going to happen again. All right. So that was the gap fill. Now, as for the golden rule, right? So this will tie risk management, be prepared to lose, and golden rule all in one. So pretty much what you want to do is have a target and then have a stop loss. Okay, for example, I'll give you an example of a terrible risk management. All right, so this is what I mean by terrible. Okay, so what I'm going to do is get my calculator out, and then I'm going to get another calculator out. All right, so pretty much I'm not going to be looking at ATOS because that was just an example for gap fills. But in this case, I will give you an example of not good risk to reward management. So got my trusty 3 calculators here. All right, so here's the thing. Not proper risk to reward. Okay, so stock like this, say we knew about this, okay? So for example, what you can do is that we'll do $1,000, okay? So first off, this is your account, $1,000. And then what's going to happen is this. Say you bought with $1,000. Okay, so I'm going to go right here. Whoop, that is too big. All right. So say you had $1,000. Okay, and then you bought it at 6.5 because you're just so good. All right. So you go divide 6.5. Perfect. So you can buy 153 shares. Okay, so 153 shares. All right, with $1,000 account. And then it goes all the way up to, say, 10. You sold it at 10. So how would you find the profits, the difference? So again, this is per share. This is how much money you have, and this is how many shares you can buy with that amount of money. So then, how do you find the profits, right? So you go from, let's see, $10 minus $6.50, and that is your profit. Okay, so you profit $3.5 a share. So then you go times 3.5. All right, now you're pretty excited. So for your $1,000 account, you're now positive this much money. All right, so that's your total account. And now you just sold out, so you have 0 shares. And then this is your profits. All right, so now you get really excited. You go like, oh my God, I have 50% of my income. Let's do it again. And then you buy it down here. Okay, so remember, this over here, it is dangerous, but it could go the other way as well. So say, for example, you're just another beast, okay? You're just a beast. And then you take your money, your money that you won, and then you're very happy about that, all right? And then you bought it at $8.50 because you're just so good, all right? So you bought it at $8.50. Now you have 180 shares, okay? 180 shares. It's not Bitcoin, so you can't buy partial shares, but 180 shares with this much money. All right, you bought it at $8.50, and then it goes all the way up to $11. Say you're a beast and you just sold it at the tip. All right, and then you're just feeling really good. So again, to find the profit, $11 minus $8.50. All right, that's $2.50 per share. So you take your shares, multiply it by 2.5. That's $4.50. Then you go like, oh my God, I'm just so good. I have an extra $4.50. Now your account looks like this. Okay, so when you're up here, okay, usually what happens is that, well, when you took out profit right here and it goes up to 12, usually the typical person does kick themselves and go like, oh, I should have held. And then they get a little bit of fear of FOMO, fear of missing out. Because what you can see here is that, well, the target could be at 14, around 14. And then you go like, no, it's going to go back up to 14. So what you want to, what you don't want to do, if you practice, proper risk management, so what you would do is, okay, so I'm going to get back in. This is what the typical person does. Typical person goes back in and goes like, okay, I know it's gonna go back up, so I'm gonna buy it. Say you're a beast and you buy it at 11. All right, buy it at 11, and then you can buy another 180 shares. All right. So what happened afterwards? Okay, so you bought it here, and then you expect it to go up, but it goes to the bottom here, and you go like, no, it's gonna go to 14. It's gonna go to 14, and as you go to 14, it doesn't work out for you. So, like I said over here, all right. So let me get my 3 calculators up. As you can see, it does not go to 14. It goes all the way back down to this area at $8, and then you go back. It goes back up here, and you go like, it's gonna go to 14. It's gonna go to 14. You hold it. After a couple of days, it goes back to 650. So you take your amount of shares. Now you're negative 650. So let's do the math there. You bought it at 11, goes down to 650. All right. Well, that is incorrect. Sorry about that. Let me just do the math again. All right. So it goes to 650. All right. You are now negative $4.5 a share. So that means times 4.5. Now you're in the negative. You lost $810. So you go negative 810. All right. Now you're feeling so good about almost doubling your account. Now you don't feel as great because of this. Now, that being said, for you, this over here is typically what the person does. You're going like forward, and then you go backwards by a lot, and it demotivates you. So what you want to do is put those risk management practices into place. So first thing is, let's do this all over again, but with proper risk to reward. Okay, so let's start over. So over here, $1,000 account, right? $1,000 account. You bought it at, $650. So you bought it at, $1,000 divided by, 6. Oh, didn't even do it yet. Okay, $1,000 divided by 650, because you're buying all the shares at 650. 153. All right, that's the amount of shares you got, and it goes up. You sell it for $11. So again, how to find the profit? 650 minus that. That's how much profit. Okay, times 4.5, and then 688 plus 688.5 into your account. You're feeling good. Now, what you don't want to do is go back all in, because you did make a big win. Anything 30% and above is a gift, but you made 68%, which is very good. So proper risk management is this. Now you don't want to go back all in. You can, but you shouldn't if you want to protect your capital. So what you'd want to do then is pretty much 688.5. You're playing with your profits, and you want to go in on the second move if there is. We don't know, but you're not risking all of it. So you bought it, you're a beast, and you bought it at 650 again, right? Was it 650? Oh wait, no, sorry, 850. Okay, say you're a beast and you caught the bottom. Okay, you're just so good. You caught it right here. You bought it right back because you know it was gonna go up, right? All right. So now you have 81 shares. Okay, now 81 shares isn't a lot, but you're only using the profits. That's house money, like a casino, right? You go in there with $100, you win 500. You're feeling great, and you go like, no, I can keep going. You make $1,000, and you're just super happy. But then what happens is that something triggers in your mind to make you just keep spending that money, and then pretty much you're back down to zero, or you break even, which is still fun, but you don't want it to be back to zero. That's technically what the first example was. You don't want to just keep going all in, or else you'll go back to zero profits. So now talk about this over here, 81 shares, and it goes back up to $11. Okay, so you're at $11 and you sold it. You sold it at 11, but you bought it at 850. All right, that's a $2.5 gain. So 2.5 times 81 shares, you gained 2025. So you go plus 2025, and this is a good chunk of change. All right, now when the example was, it goes back up, you start kicking yourself, and then you go like, okay, I'm going to be a beast. I'm going to buy it at 11 because the target's 14, and I know it, right? You think like that, and then you bought your beast, so you bought it at 11, which is not bad. You bought it at 11. That's pretty good. Okay, so you bought it at 11. All right, so you take your gains, right, and you go, okay, you do another move. you can go back in just profits. That is fine too. That's fine. Risk reward, you're not using your entire float, so therefore you lose less if it does go wrong, because trades don't always go according to plan. They sometimes go bad. So how you do it is this. Okay, you're taking your profits, all right, and then you bought it at 11. Okay, so you go divide 11, and you're left with 81 shares one more time. All right, so risk reward, how that's going to happen. Okay, so pretty much your target is 14. Okay, $14, but you bought it at 11. But then what you want to do is do a stop loss. So a stop loss prevents you from losing a lot of money. How does that work? Sometimes people don't even use stop losses just because there's something called stop hunts, but that's something I'm going to be talking about later on. But what you want to do is this: proper risk management. You buy 11, you're willing to lose $1 per share. So as soon as it hits $10, you sell it. You don't even care. Don't have this feeling of it's going to go back up, I'm not selling, or I'm not selling at all. But the target is 14. So you're risking winning $3 per share versus losing $1 per share. So that is a 3-to-1 golden risk reward ratio. You want to do that. That's exactly how you want to think. 3-to-1 is great. 4-to-1 is even better. But 2-to-1, 1-to-1, don't even take those. If you want, you can go ahead. But honestly, if you want to do that, that's fine. Again, I'm not a financial advisor. Do your own due diligence. But this is how I would do things. So $81, and it goes down to 10. See how it went all the way to 10, $9, and went back up. You don't go like, oh, it's going to go back up. Oh, it's going back up. You don't do that. You want to obey your stop loss. So $81, pretty much you lose. You're risking. So if it did go good for you, if it did play out, you gain, $243, or you lose $81, which is great. That is great. So, but the thing is, the stock didn't go your way. So what ended up happening was that you lost $81. All right, so now your account looks like this, and it just sold off. Okay, and typically what people do once a big move happens, they just forget about it and move on. So instead of only having, that account that you had before, you went up really big, now you're at a big loss. If you put this in practice, you're still over 81% on your initial investment. So if you practice proper risk to reward, this is to keep you safe. Like honestly, if you don't put this in place, I don't know how you're going to do it unless you just keep lucking out. But this is proper risk management. All right, golden rule 3-to-1. Always be prepared to lose. So that example, be prepared to lose $81, but also be prepared to gain 240 plus. Okay, so last topic for you is, well, it doesn't actually, I don't actually need to look at these charts, so I'll just keep it here right now. So thing is, careful when trading at this time. So the reason why I want to talk about this is because it's actually, out of my years of experience, I've actually noticed this a lot. So my time zone is PST, Pacific Standard Time. So usually from 9 o'clock for me to 12 o'clock, that is usually a no trade zone. That's when I would actually take a break from the market, look at other trades. But this over here is when all the institution big bankers, the big bosses and all that stuff, they go on lunch. And when they go on lunch, they go on more for an hour because they made lots of money. So if you're looking for that move and it's around 8:50, be careful, because what can happen if you're looking for that move, if all the big money is on lunch, on break, all you're left with is retail traders. And then what happens is that you probably won't get that big move like you expected, and it could go the other way for you. So for me, I just stay away. Another time for you is the first 15 minutes. So the first 15 minutes of the stock market is usually not the best time to trade, just because it could psych you out. So for example, let me just go extended hours, and then extended hours here too. Oh, perfect, already got that. All right, so extended hours, and this is what I mean. All right, so first thing, you see it go up, and you go like, oh my god, it's gonna go big. Okay, I'm gonna go give you another example right here. All right, so this is every candle is 1 minute. Every candle is 1 minute. Let's do 5 minute. Make it simple. All right, see this 1, 2, 3. That's 15 minutes, and then it tricks you to go up, and then it just slams you down. All right, this is where you sell, and you get all upset, and then freaking this happens, right? So this is why first 15 minutes, just be careful. You want to look for confirmation, which is what I'm going to teach you in the next one. So stay tuned for that. But you see this? Oh, it's staying still, and it goes down all the way, and you go like, wow, this stock sucks. You ignore it, and then what do you know? First 15 minutes fakes you out, and then just goes high up. Okay, it goes really high up. All right, so that's why you want to be careful. First 15 minutes, I usually sit it out, but you can play it if you want, but just have your proper risk reward management in place, and then you should have no problems. But for me, I'd stay away. Also, another time, you don't have to, well, kind of have to be careful. Power hour, that's the last hour of the stock market, and that is going to determine, your big wins or not. Just because when the bankers come back, they usually look to buy stocks for the next day, and usually you hear power hour for a reason. Is because, well, usually you get big moves like that, like parabolic moves. I've seen many times where stocks at the end of the day they just go nuts. Right? Let me find an example for you. Like, no, that's not an example. Okay. There you go. Okay, so this is right here, and it just goes up all the way. So let me just go 1 minute. Power hour. Okay, so this is where people get in, and then you see how it looked to sell afterwards. Because what happens is at power hour is that, like they come back and they buy for the next day, you get a huge increase in volume. But also the last 5 minutes of the stock market, that part is, you got to sort of pay attention to if you do have time to look at charts, because that's going to tell you if the stock's going to continue up or continue heading lower. Because day traders, they take profit at the end of the day, so therefore it might sell off, or they buy for the next day as well. If they see a strong close, they'll get in, and chances are it's going to go up. So that's something I'm going to be teaching in my other video, but just be careful on that time. So to review everything that I was talking about here. All right, so the first thing, risk management. All right, risk management, 3-to-1 risk to reward management. Also the golden rule, if you want to apply that. If it doesn't work out for you, then change your rule. But if you don't have a rule in place, you're gonna have a hard time trading. So risk management, always don't go all in. Also, be prepared to lose. Like the other example, you have to be willing to risk $81 for a possible 240 gain, and that's good. Okay, now if you don't want to be risking $200 to gain $200. That's not what you want to do. You always want to sell it. Also, gap fills. Gap fills, same thing, right? I showed you a perfect example of Kodak, how don't want to buy if there's a big gap. You want to buy it as soon as it fills the gap, because that's when the moves happen. And then when you buy where the gap fills, like I showed you about Kodak, if you do the gap fill buy and then you set the 3-to-1 risk to reward, there's a really high chance of you just being super successful and doubling your account. All right, again, golden rule, 3-to-1, but you can add other rules. For me, I added a couple other rules for myself, but that's really up to you. And also careful when trading at this time. Typically be careful, lunch hour, that's the worst. But again, just to review it, all right, first 15 minutes, be careful. From 9 to 11 PST, be careful. From power hour, last hour, be careful. And also the last 5 to 10 minutes, be careful as well. So hopefully this will help you become a better trader. After all my years of trading, everything that I've learned, these are seriously, this is the game changer for me. So hopefully this helped you become a better trader. If you're more advanced and you didn't know about these, look it up. It might give you an edge. And also if you're a beginner, 100% look these up, study it, because you're gonna be wanting this. If you ignore one of these, you're gonna have a bad time. But just try to, whatever works for you. If it's working out for you, then keep doing it until it doesn't, and then look to change it. Okay, you don't want to be doing the same thing over and over again and expecting a different result, because by definition that is insanity. So you don't want to be insane. Just play it safe if you want to become a successful day trader or swing trader. So that was it for me. I'm going to be wrapping this video up. Hopefully this helped you out. Hopefully this clarified some things. Hopefully you like the calculator as well, because that now, becoming a trader, I have a calculator like all the time. It is wonderful. I don't want to have to, I want my brain to be looking at charts, looking at analysis, looking at different volumes. So a lot of bandwidth is going there. Last thing I want to do is do actual math without a calculator, because that would really hinder me. But I'll be seeing you in the next video. Subscribe if you haven't already. Stay tuned for my other videos, and I'll see you in the next one.